Care for My Wealth with Chris Kline of Capstone Wealth Management, your fee-only investment firm. Now, here's your Care for My Wealth guy, Chris Kline.
Hello and welcome to another edition of the Care for My Wealth Show. I am your host, Chris Kline, and I come to you from Capstone Wealth Management. We are a private fee-only investment management firm with risk management at the heart of what we do. So we are an active management company. We actively manage portfolios for individuals, for businesses, for foundations and 401ks and kind of everything in between. If you'd like to find out more about us, you can do so online, careformywealth.com. That's careformywealth.com. If you'd like to interact with me, that would be great. You can do that online. Email, that is, info@careformywealth.com, or online on X, which was, of course, Twitter. And the handle there is @careformywealth. So what are we going to talk about today? Well, there's lots of things happening in inflation space, as we all know. On Tuesday morning, very early, the inflation report came out, that's CPI, Consumer Price Index, and it came in hotter than expected. Now that's interesting, right? I had been talking about we probably would see a deceleration. So, you get some chirpers out there that say, see, you're wrong. No, we weren't wrong. It's just that the report came in hotter than what the market expected, but there was still a deceleration. Now you ask, what are you talking about? Well, we have to look at something called a base effect or a comparable. And the comparable is always the previous year, or in some cases 2 years. Just depends on how you're structuring the comp. But in most cases, a comp is just simply looking at the same quarter from the previous year and then comparing the two. And if one is higher than the other, the most recent one, for example, then that would be an acceleration. If it was lower than the previous year, well, that's a deceleration. And even if that number that's reported is above or below what markets expect, eventually markets will look at whether or not the acceleration or deceleration is taking place. And that's what we got. So we got 3.1% on CPI, according to what the government's reported anyway. And that is hotter than expected. That was a deceleration like we anticipated would take place from the previous year's same quarter, previous year though. That reported was 3.4%. But, and this is a really important thing, there was an acceleration on a month-over-month basis from 0.3% to 0.4%. And guess what? The bond market did not like that one bit. The U.S. 10-year Treasury yield jumped 11 basis points on the release. That was not something that markets were prepared for. And so, of course, on that same data set, you saw some fireworks in the stock market too. The S&P 500 was down 1.37% on Tuesday. If you looked at the NASDAQ that same day that the CPI came out was down 1.8%. And if you look at the small caps, the Russell 2000, that thing got bludgeoned down 3.96%. So that was certainly an interesting day. Now, one day doesn't make a market. And we had been talking about how all of those markets are in a bullish trend. So again, if you're tuning in for the very first time, welcome. I appreciate you listening in. I hope you go back and listen to some of our archive shows. You can do so at our website, careformywealth.com. You can do so on all the major podcast platforms, but probably easiest to obtain them from our website, careformywealth.com. And one of the things that you have heard me talk about was something called trade and trend. And these are things that are very valuable when it comes to understanding how markets function. They're not just a single factor element like a moving average. This is a calculus that we do that contains price, volume, and volatility. Three very important elements of helping understand what's happening inside markets, what's making markets move. And one of the things that I have been saying is that the S&P, the NASDAQ, and the Russell 2000 are all trading in a bullish trend. So a trend is just a calculus of price, volume, and volatility of the time series of 3 months or more. That's all that means. That was an important thing because on Tuesday, even though markets got whacked, none of them broke trend. Now, a couple of them did break the trade value. Trade value is just a shorter time series. It's price, volume, and volatility with a time series of 3 weeks or less. Why is that important? Because in most cases, when that level is broken, either below or above, algorithms in the market want to chase the market in the same direction. So if a market has been trending bullish and it breaks down below that trade level, it's the first indication that, maybe there's something wrong. And in many cases, there's a continuation of that sell-off. That happens very, very frequently. Same thing is true that if a market is trending bearish and all of a sudden it breaks up above that trade level, well, then all of a sudden that's something different. And that's the first indication that it might go through a phase transition from bearish to bullish trend. So on Tuesday, we had a situation where the S&P dropped below that trade level. Same thing happened for the NASDAQ, dropped below that trade level. Interestingly enough, didn't happen on the small caps, held that trade value. So, of course, none of them broke the trend level. And then what did we get on Wednesday? Markets shot right back up. That's right. S&P was up over about a 1%, NASDAQ over 1%, small caps up 2.4%. Volume wasn't crazy. It wasn't something that would, make you go, ooh, oh, yeah, everybody's buying. But it was enough to suggest that that certainly the rally isn't over. One of the things that I had also talked about over the past few shows is an interesting setup in volatility. And one of the things that I had been commenting on to my emails to clients each morning, yes, if we're blessed to work for you and you happen to be a client, then you'll get an email from me every day that the U.S. equity market is open, and I'll give you what is on the top of my mind. And it's a simple 3 bullet point email that just shares with you some things that are happening from a market and economic perspective that maybe will make a little bit more sense to some of the data that's being reported. Because let's face it, the data that's getting reported these days is, odd. And it is what it is, so we have to deal with it. But one of the setups that we've been talking about within volatility space is that the trade level has crossed up above the trend level. Now, most of the time when you see that, that's a very interesting setup in that it purports the likelihood of a move towards a bullish trend. Now, that's interesting. We had a situation with volatility, and when I say volatility, I'm specifically in this instance talking about VIX, the S&P 500 Volatility Index, if you will. And VIX broke up above that trade level some time ago, back in January, and I had commented that if it continues to stay in this level, it's going to break to bullish trend. Well, it broke to bullish trend on February the 9th. And I said, the fact of the matter is that, and I said this in my email to clients, I said, the fact of the matter is that we have a situation where trade is above trend that suggests that volatility could in fact move higher, and it's happening within a bullish trend. And what did we get on Tuesday but volatility spiking roughly 14%, and at one point got very close to 18, hit 17.94. Now, why does that matter? Because I had also commented that if we see VIX bump up into the 20s, markets are probably going to get ugly. In most cases, markets perform opposite of volatility. If volatility ramps higher, market prices tend to drop. And certainly we got that on Tuesday. So here we had a situation where we were seeing over a couple of day period a rising calculus of price, volume, and volatility within the subset of a bullish trending VIX cycle. And I said, just anything can happen, but when you have that setup, it tends to want to move itself higher. And we got that on Tuesday, big. Well, then on Wednesday, what happened? Volatility broke back down, and it broke back down into bearish trend. Now, is it going to stay there? You never know until it changes. But as of right now, you still have a situation where trade is above trend. That's fairly risky in terms of suggesting that we could, in fact, see a spike in volatility again. And so, you go with it and you say, all right, well, volatility is breaking back down, and it did. VIX broke down over 9% on Wednesday. And so, okay, fine, whatever. You keep moving with it, and you recognize, all right, if volatility is in a bearish trend, that suggests and purports the likelihood of the index, in this case the S&P, being in a bullish trend. And so therefore it creates an environment where you can stay invested on the balance, right? What was interesting is that when you take a look at the data that has been coming in, those who are expecting or hoping, maybe is the more appropriate reading, that the Federal Reserve cut interest rates, you probably want to rethink that. Now, why do I say that? Well, the stock market is at all-time highs. Okay, that's interesting. Housing prices are very near all-time highs. Bitcoin, multi-year highs. The early retirement type scenario is kind of surging, right? I mean, companies are finding ways to try and help minimize their cost structure. So many are offering early retirements. That's going up a lot. What does that do? It makes the labor force tighter. CPI, as I mentioned, on a month-over-month basis is showing a reacceleration. And it's also happening within the context of oil. Oil is one of those things that has a big control set on inflation. Services PMI are showing prices on the rise even faster than before. So you have to ask yourself the question, what are the reasons that the Fed has to cut interest rates anytime soon? I'll answer that. None. And the market's waking up to that fact. In addition to that, the market may in fact be waking up to the possibility that even though we're in a Goldilocks scenario, well, now what's Goldilocks? Outside of the children's story, Goldilocks just simply means that we've got growth accelerating alongside inflation decelerating, right? However, if inflation does accelerate with growth, that can, in many instances, be even better for the stock market, just like what we saw in 2021. And so there are a lot of people out there who are of the belief right now that just because inflation is reaccelerating and the market took it on the chin on Tuesday, that was the beginning of the end and we're going to just see everything implode on itself. And I have to say, I don't know that that's the case. Now, do I think that VIX, the volatility segment for the S&P 500, is very important? I do. I do think that it is probable that we see VIX, at least over the next, maybe several days to several weeks, that we see it continue to pull back. Now, if I saw it come down to about 11.5 and hold, I'd start to get concerned that the next move is going to be higher because that's the current trade level. If it breaks down below that and then breaks down below 11, then we may be in for a bull market spike that we haven't seen in quite some time. But just because we have inflation accelerating doesn't necessarily mean that that's a death knell for the bull market cycle, if you will, right? It changes the Goldilocks scenario, but it's a reacceleration of inflation alongside acceleration of growth. That can be extremely good for stocks. So we have to pay attention to those basic elements that I just mentioned and those trend and trade levels on VIX. If those get broken, that'll be fantastic. If you're a bull. If you're a bear, well, then you're not going to like that. You're going to want to see VIX stop at that 11.5 level and then bounce higher. What do? We don't care. Now, that may sound a little brash, but I don't care. What I care about is what is the math telling me, number one. Number two, what is the market doing? The math is telling me what it's telling me. It's telling me that the stock market, the S&P, the NASDAQ, and the Russell 2000 are all three bullish trend. It's telling me that the VIX volatility control for the S&P 500 is bearish trend. That confirms each other. What else is it telling me? Well, it's telling me that the U.S. dollar, which is important. Why? Because the U.S. dollar is where almost all global transactions take place. But the U.S. dollar has a positive correlation with the S&P 500, and the U.S. dollar index, symbol DXY, is also bullish trend. So we have one confirmation after another. The cog in the ointment, if you will, the fly in the ointment, the cog in the oil, whatever analogy you want to use, are yields. Yields are different. Why? Well, because all three major yield structures, the 2-year, the 10-year, and the 30-year, all moved back into bullish trend. Now, I commented on this a little bit earlier where I had said that the U.S. 10-year Treasury was moving towards bullish trend and it needed a few days to figure out if it really was a bullish trend. Well, with the move that we got on Tuesday, which was a pretty big spike, that bullish trend is confirmed. Now, what's likely? Likely is that it bounces around in between its trade levels. For the U.S. 10-year Treasury, the trade level would mean that it would bounce between about 3.95% and about 4.48%. Bouncing up, bouncing down, but potentially in an upward fashion. That is something that is a little bit new because yields have been bearish trend up until now, ever since November of last year. And everybody anticipated that yields would be dropping because the economy was slowing. We're getting into a more deflationary cycle. Recession action and recession activity continue to percolate higher. The likelihood is that the Fed was done raising interest rates. And here we are back right where we were in an earlier cycle where inflation is reaccelerating, and the bond market's confirming that by simply sporting bullish trends for the 2-year, the 10-year, and the 30-year. And the 2-year is consistent with what the Fed funds rate would be, simply because the short end of the yield curve is where you find the Fed functioning and acting. So there's a lot of things happening in market space right now, and there are many, many things that are yet to develop and yet to happen. And we're going to unwind and unpack a lot of that during today's show. So stay with us. This is the Care for My Wealth Show. I am your host, Chris Kline. If you'd like to see more about us, you can do that online at careformywealth.com. You can email me info@careformywealth.com, or you can call the old-fashioned way, 866-596-9886, 866-596-9886, and check us out on Twitter or X, which is @careformywealth. So again, we'll be back in just a moment. This is the Care for My Wealth Show. We'll be back in just one moment.
What if there was a product that could help you control cravings, burn more fat, boost your metabolism, promote healthy blood glucose levels, lower inflammation, optimize insulin sensitivity, support healthy blood lipid levels, and support healthy blood pressure? Introducing Bellatrim. Bellatrim may be the most comprehensive body transformation product in the world. Weight management is more than calories in and calories out. It's about controlling appetite, having a healthier gut, supporting insulin function, stimulating fat-burning metabolism, and promoting healthy blood lipids and blood pressure. A proprietary blend backed by 6 clinical studies. Control cravings. Burn more fat. Bellatrim, powered by nature. Backed by science.
For more information, go to newuinsideout.com. That's newuinsideout.com. newuinsideout.com.
Hello, I'm Mike Lindell, and I'm excited to announce my new product, My Coffee. When I tried My Coffee for the first time, I was blown away. It's the best coffee I've ever had in my life. And it starts with the beans that are grown in Honduras. They have the perfect climate for growing coffee plants, which produce the best beans ever. Each batch is tested to meet the highest industry standards, and all the production's done right here in the USA. It's like you're getting that small batch specialty coffee delivered right to your front door. And you can get them ground or whole bean or in the single-serve coffee pods. Plus, it's certified organic and non-GMO. And I guarantee it'll be the richest, smoothest, best coffee you've ever had.
To get 25% off the best coffee you have ever had in your life, go to mystore.com and use promo code CAPSTONE. That's mystore.com, promo code CAPSTONE, or call 1-800-664-5726, promo code CAPSTONE. That's 800-664-5726, promo code CAPSTONE.
When I was 49, I went through a traumatic, major change in life. My health started going down. I really struggled. Every cell in my body ached. I struggled to find words. My ankles were turning black, literally, from the blood pooling in them. I had thumbs that did not work, so I had trouble putting things in the oven, taking hot things out. Couldn't do that. Grasp. Couldn't do that. And I was concerned that I would not live as long as my parents, who lived, my daddy lived to be almost 94, and he was vibrant. Mama was 85, that's in my genetics, and I didn't know that would happen with me. Things are totally different now because of this wonderful elixir that I take. I have just seen a total turnaround in my health. I can use my hands. I've got hands again. I thank God for that. I've got hands I can use, but I also have a brain now that works, and I can recall names. I can recall things that I could not before. I mean, it works. It's much more agile. So it goes, this stuff works in your mitochondria. It cleans it all out. It just affects every area of your life.
For more information, go to newuinsideout.com. That's newuinsideout.com. newuinsideout.com.
You're listening to the Care for My Wealth Show with Chris Kline of Capstone Wealth Management. Check us out online at careformywealth.com or on Twitter, now X, at Care for My Wealth, and also all the major podcast platforms.
Introducing Bella Grace Collagen Lip Plumping Serum. Hydrate, plump, slay. Age-defying nutrients your lips will love. Visibly plumps lips. Reduces fine lines and wrinkles. Softens and hydrates. Instant hydration meets long-term plumping power in one sleek bottle. Get ready to slay the day and night with the Bella Grace Collagen Lip Plumping Serum.
For more information, go to newuinsideout.com. That's newuinsideout.com. newuinsideout.com.
All right, we are back. Welcome to the Care for My Wealth Show. I am your host, Chris Kline. Come to you from Capstone Wealth Management. You can find out more about us online at careformywealth.com. That's careformywealth.com. You can interact with us on X at careformywealth. That's our handle, at careformywealth. Or you can talk to us the old-fashioned way, 866-596-9886. Okay. So we just got done talking about how the Fed has done what they are hoping to do, and that is break inflation, right? Now, there's a company out there or an operation that calculates daily inflation and uses somewhere to the tune of like 18 million data points or something crazy like that. At any rate, it's Trueflation. You can go online and find out all about Trueflation that you want. And Trueflation had been showing for the longest of time that inflation was actually decelerating at a much, much faster clip than what the government was saying. In fact, the last number that Trueflation had was somewhere to the tune of about 1.3%. Now, look, that's a big difference from 3.4% that people were thinking of, and certainly 3.1% that came out on Tuesday's CPI. And so people look at that and say, well, wait a minute, am I looking at this wrong? I mean, Trueflation's data, which is getting some traction out there in the marketplace today, was way lower than what the government reported. No, you're reading it right. The reality is that Fed Chair Powell's mission is to kill what's called the Fed put. Now, what's the Fed put? The Fed put simply is this expectation by market participants that if markets fall or crash, or something really bad happens, they're going to rescue the market by liquefying the system with more and more money. Look, one of the problems that we're in right now, this boom-bust cycle that we have to go through all the time, is the fact that there's so much money sloshing around in the system, and that the Fed, that they just keep printing money. And look what that's done. We've got $34 trillion of debt. We've got $2 trillion of annual deficit problems. These are very real issues. The fiscal situation of the United States is on, as Fed Chair Powell has said, an unsustainable path. If he truly believes that, then his objective, his mission in life, is to get rid of that Fed put, this belief that just because markets go through a bad bear, a difficult cycle, or even a crash, that the Fed's going to rescue it with liquefying more and more and more and more money into the system. Now look, he's going to find a way to get behind any amount of data that is going to confirm his ability to stay the course of interest rates higher for longer. You can go back several shows, even a year, where I've talked about this on podcasts and programs that I've done on other radio shows, that the Fed is going to be in a position where they're forcing a higher for longer interest rate cycle. And that can come and look in a lot of different ways, but the reality is that higher for longer means exactly what it says. Higher for longer. Higher Fed funds rates, higher U.S. Treasury yields, higher expenses for corporations and individuals and businesses as the borrowing capacity, the cost of capital has gone up. All that's out there. And if he's got the capacity to stay behind any data that is hotter than normal, to stay the course of continuing that push towards higher for longer to kill that Fed put. He's done it for almost 2 years now, by the way. I mean, if that's the objective, if that's the goal, to regulate the Wild West, if you will, of Wall Street that are, hiding behind the shadow banking system, that is a thing, right? If the goal is to regulate all these Wild Westerners out there running the non-banking system, well, then he's going to continue to do that. And if we get some data points that come in that have the inkling of hotter than expected or a re-acceleration of inflation, he's not going to jump in and just kill the current interest rate cycle or cut interest rates at the moment's notice. And so we have to recognize we're in a little bit of a new regime, right? Okay, fine. Does that mean that all investments are now going to just be terrible? So for example, a 60-40 portfolio that you might find at your work or in your 401k or something that is a target date fund. By the way, I don't recommend target date funds for a whole host of reasons, but we'll leave that for another show. Nevertheless, many people's choices inside of a 401k are very, very limited. Like you don't have many... you don't have much ability to kind of go outside and construct yourself a portfolio of exchange traded funds or maybe maneuver around within the asset classes more actively. They penalize you if you trade too much, all sorts of stuff, right? So an average 60 portfolio or a target date fund, if stocks are not good and if rates are going up, well, then that puts some pressure on bonds. If rates are going up, that's going to put some pressure on gold, right? Well, now what? If none of those are in a great space? Well, remember what I said at the beginning of the show, the first segment. Just because rates are going up doesn't necessarily mean in and of itself that is a death knell for U.S. equities. Sure, it makes it harder for bonds, no doubt about it. Absolutely makes it harder for gold. Why? Well, gold's a rates play. A lot of people don't realize that. Most people look at gold and say, oh, it's an inflation hedge. Yeah, I get it. That's the belief, that's the expectation, but it's really more of a real rates play, meaning when real rates are rising, gold isn't going to do so good. When real rates are falling, gold will do great. And so you can go back and you can look at real rates. It's just current interest rate, nominal interest rates, if you will, minus inflation. And you look at that through that lens and ask yourself, okay, well, how did gold do when real rates were rising compared to real rates are declining? I can tell you, they move opposite of each other. And right now, we've got a situation where real rates are rising. In fact, the real rate segment that we track day in and day out is in a bullish trend, making higher highs and higher lows. That's a big deal. That's not good for gold. That's something that if you're just dying to buy gold and get your hands on more and more and more, because all the clickbait says that all central banks across the globe are buying more and more and more gold. And if we've got inflation, you got to buy gold. And the US dollar is going to go away. And, right? I get it. I hear it all the time. The deep state's going to crash the market. All right. Okay. I can understand why someone would feel or believe that just simply because there's so much negative data, negative information, clickbait out there. But I guess I have to ask myself a question. If the deep state is running the country, and I sort of tend to believe that they are, at least right now, why would they want to crash the market in an election year? I mean, come on. These guys are going to do whatever they can to try and make it look awesome, look amazing. Look what we've done, so that, of course, the electorate doesn't throw them out of office, even though that probably should happen. Hey, I digress. At any rate, the U.S. dollar is bullish trend. Let's not forget that, right? Symbol DXY, that's the dollar index. Over the last week, it's up over 0.5%. Over the last month, it's up over 2.25%. Over the last 3 months, it's up over 30 basis points. It's trending higher, right? It's a bullish trend. And the dollar being a bullish trend is interesting because there's a positive correlation with the US, with the S&P 500 and with Bitcoin. Now, does that mean just because the dollar goes up, those markets go up? No, it just means it's a tailwind. It means it's going to work alongside it. It's going to help it, not hurt it. That's probably the best way to view it. Inflation is still a problem. And we recognize it. There's something called the common man inflation rate out there. And, there's probably some different ways that people might define that. But, the way I look at it is fairly simple. the things that we, the common people of the United States of America, have to pay for to live. How about food? How about rent? How about homeowners' costs? If you own a home, either of those, you're going to own a home or you're going to have rent, right? If you own a home and it's not paid for, you have a mortgage cost. How about car repair, hospital services, transportation costs, car insurance? Those are the things that we spend money on. Of course, the CPI data, they want to exclude food and energy for core services and things like that. Well, that's ridiculous. That's dumb. But yet, what do we have? Well, car insurance inflation is up 21%. Transportation inflation's up almost 10%. Hospital services up 6.7%. Car repair inflation up 6.5%. If you're a homeowner, that's not free. You're still dealing with inflation, repairs and the like. That's up 6%. Rent's up 6%. Food away from home. If you just want to go out to eat from time to time or get a, 99-cent heart attack in a sack, it's 5%. Look, give me the reasons with that happening that we don't see inflation reaccelerating. And under that set of scenarios, what is it that the Fed's going to do to cut rates? Nothing. It's not going to happen, at least not in the near term. So, markets have started to price out interest rate cuts in 2024. In just the last 6 weeks, markets have canned 2 of the interest rate cuts that markets expected for this year. All right. Well, markets got very excited about that. Now, again, I have to say that when you have growth accelerating, which currently we do, alongside inflation accelerating, that's an economic cycle that market participants still get excited about, that stocks still do well in. In fact, some of the junkiest of junk stocks can do really well in that environment too. Think of 2021 when you had SPAC, special purpose acquisition corporations, out there with all the garbage of garbage, letting these things get public through that process which is a cheaper process, going through a SPAC versus an IPO. And then they roll it out. And, whoa, hallelujah, thing goes up 400%. Number of instances in 2021, that's exactly what we saw. Could that happen again? Absolutely. That could happen. There could be one final hoorah before markets tank. Happened in 1999. Is there anything to suggest that it won't happen this time? Well, what would keep it from happening this time at all would be if the Fed reliquefied the system. Now, I have to quantify a couple of things that I think would be helpful for you as a student of the market or a participant of the market, which hopefully if you're one, you're both. But that has to do with the money supply. And when you think of the money supply, you think of money sloshing around in the system. And what you think of when you think of that, it should be cash, savings, CDs, things readily convertible to liquid cash, right? What's important for you to know about this is 2 things. Number one, it's going up again. Now, yeah, I know there's lots and lots and lots of data that shows, well, yeah, but that's called M2. Cash in the system peaked out in April of 2022 at $22 trillion. And it came all the way down in October of last year to $20 trillion. Yeah, that is 100% accurate. You are correct. But if we look at how M2 or cash in the system has been responding, just basically since October of last year, it's gone up by a couple $100 billion. Money's not coming out of the system. Yes, I know the Federal Reserve is telling everybody that they're reducing their balance sheet, and that may be happening, but M2 is accelerating. But here's what's even more important than that, and that is important. Acceleration of M2 is important. What's more important is if we look at, well, where was M2 before the whole pandemic thing hit, right? Like, for example, January of 2020, before the whole thing really started going global, M2 was at a little over $15 trillion. Oh, yeah, that was a lot. And even though the Fed has reduced their balance sheet, even though the Fed has taken money out of the system, we're still almost $21 trillion today. That's a dramatic increase from just where it was in 2020. So again, we have to think of the accelerations that are taking place in important things like the money supply. And that's very supportive of, in most instances, a bull market. So does it mean you can't have a bear market without M2 declining? No, Not at all. You can, in fact, have very damaging and very dangerous bear markets with M2 rising. The great financial crisis occurred with M2 rising. You go back to the dot-com era. We got the dot-com implosion with M2 rising. We had the 2020 collapse. Now, granted, that was, the fear of the whole pandemic thing happening. And of course, markets collapsed on that fear of that, oh, guess what? The world shut down. But M2 on a year-over-year basis had still been rising. So we have all these things happening outside of the norm, if you will. And so we have to recognize that those things are still taking place. We also have something called the velocity of money. And not to get too nerdy or wonky, but velocity of money is just that. It's the speed that money happens to go through the economy. The more velocity you have, the faster money's going through the economy, the more it's getting used, the more bullish that is in general for markets. And what's interesting is if we look at what the velocity of money was in 1997 and compare that to where it was in 2020, is about half. That's interesting. But since then, it's been going back up. So what do we have? We have a lot of money in the system. We have a Federal Reserve that is really, really interested in killing the Fed put, the expectation that they're going to ride to the rescue on any market crash or collapse. And we have a situation where M2 is higher than what it was in 2020, and now it's rising again alongside the fact that velocity of money is also going up. Those are all things that are not in and of themselves bearish. What else is not bearish? Well, what else is not bearish is speculation. Now, speculation can come in a lot of different forms, right? And one of the ways that people speculate is in the crypto market. So what's happening with crypto? Great question, and I will answer that for you on the other side of this next break. So don't go away. This is the Care for My Wealth Show. I am your host, Chris Kline. We'll be back in just a moment.
One thing that we all share is the desire to be healthy. The question is, how do you get to that place? Sometimes diet is just not enough. There are gaps, and there are some nutrients that are just not found even in a healthy diet, and the answer is supplementation.
And if everyone knew it was 6,000 times stronger than vitamin C, 500 times stronger than vitamin E, they'd all want to take astaxanthin. But personally, when I'm looking at a nutraceutical or a supplement, I want the highest quality, but I also want it based on clinical studies. And they are the most clinically studied astaxanthin in the marketplace. And that's important to me. It's important to me, my family, and my patients to recommend it based on scientific studies. When you go into these facilities, you're really taken back by the advanced technology. All for this algae to be able to make this astaxanthin, the efforts, the amount of technology that goes into it, it's something that you have to see to believe. So this advanced technology was just full of clinical precision. The bottom line is they were setting up the perfect ecosystem for the algae to make the highest purity and highest quality natural astaxanthin in the world. But once people understand what this wonderful thing from nature can do, everybody will want to take natural astaxanthin.
For more information, go to newuinsideout.com. That's newuinsideout.com. newuinsideout.com.
Hello, I'm Mike Lindell, the CEO of MyPillow. My passion has always been to help each and every one of you get the best sleep of your life. Well, radio has helped MyPillow become the amazing company that it is today. And my employees and I want to thank you with some of the best discounts ever. Just go to MyPillow.com right now and click on the radio podcast specials. There you're going to find deep discounts on all MyPillow products, including the new 6-pack towel sets for only $29.98. Bed sheets for as low as $24.98. and 50% off MyPillow 2.0.
To receive any of these amazing offers, go to mypillow.com and use promo code CAPSTONE. That's promo code CAPSTONE. Or call 1-800-664-5726. Promo code CAPSTONE. That's 800-664-5726. Promo code CAPSTONE.
Well, I love the hair, I love the nail, I love the skin and the beauty that everybody talks about. Those are the obvious benefits. But one thing I don't think people understand is what it does to the inside in terms of your joints, inflammation. Those are two things that are huge to me. Getting older, my gym workouts hurt a lot more, time after time. So my body's starting to wear down a little bit. My health in terms of my post-workout inflammation and the recovery in the next few days after those heavy workouts it's changed dramatically. There's nothing that has had an impact on me like this has. But I have a whole medicine cabinet, and it's not for prescriptions. It's for folic acid for my hair. It's niacin for my immune system. It's collagen pills that I was taking off of Amazon. It's protein powders. What has changed is now I have one box, and it's filled with collagen elixir, and it essentially covers everything that all those other products did. And I mean that with all my heart.
For more information, go to newuinsideout.com. That's newuinsideout.com. newuinsideout.com.
You're listening to the Care for My Wealth Show with Chris Kline of Capstone Wealth Management. Check us out online at careformywealth.com or on Twitter, now X, at careformywealth, and also all the major podcast platforms.
What if there was a product that could help you control cravings, burn more fat, boost your metabolism, promote healthy blood glucose levels, lower inflammation, optimize insulin sensitivity, support healthy blood lipid levels, and support healthy blood pressure? Introducing Bellatrim. Bellatrim may be the most comprehensive body transformation product in the world. Weight management is more than calories in and calories out. It's about controlling appetite, having a healthier gut, supporting insulin function, stimulating fat-burning metabolism, and promoting healthy blood lipids and blood pressure. A proprietary blend backed by 6 clinical studies. Control cravings. Burn more fat. Bellatrim, powered by nature. Backed by science.
For more information, go to newuinsideout.com. That's newuinsideout.com. newuinsideout.com.
All right, we're back. This is the Care for My Wealth Show. I am your host, Chris Kline. Thank you for joining us today. We are talking about all sorts of things. By the way, if you'd like to touch base with us, you can do so via email, info@careformywealth.com. You can check us out online at our website, which is careformywealth.com. You can interact with us on Twitter, X, @careformywealth, or you can call us toll-free, 866-596-9886. That's 866-596-9886. Most of the time, people start an interaction with us via email. You just drop us a line, ask a few questions, and I can help answer a number of things that may have to do with what your current situation looks like and what you're hoping to achieve with respect to investment management, where we are in this market cycle, and everything else. So just before the break, I had posed the question, what's happening with crypto? Good things. Speculation tends to happen at the beginning stages of reasonably good markets. And so what do we have in crypto? You have some speculation because crypto is, to a large extent, speculative. Bitcoin has really done wonderful here in the most recent turn. And, since the beginning of the year, if we look at how Bitcoin has moved, it's year to date, it's up like 23%. Okay, well, that's pretty good. And it continues to accelerate. I mean, just over the last week, it's up 20% alone. But it doesn't stop there. It's the same with Ethereum. It's the same with Avalanche. It's the same with Chainlink. It's the same with IMX, right on down the line. Now, some have suggested that you don't really see the movement of a bull market until you start to see the altcoins moving hard behind Bitcoin. And there's a number of structural altcoins that are available out there, IMX, Super, Beam, Mavia. These kinds of things have a tendency to move really hard after we see Bitcoin move. And Bitcoin's moving. It broke above 50,000. It's continuing to stay above that level at this point. Now, is it just going to go straight up? It can. Will it? Probably not. It usually doesn't happen that way, but it can move very, very fast. It has the volatility complex that you would tend to see in commodities, which is ordinarily a little bit higher than certainly currency. And that would absolutely be the truth for those altcoins that are out there. So this isn't a suggestion that you go out and just pile drive into the latest altcoin or Bitcoin or Ethereum or anything else. Some people who are structural engineers, people who are computer engineers, and they understand the network interface of some of these crypto type things, certainly better than what I would say I do, have suggested that Ethereum as a network is just junk. Doesn't work very good. May or may not be true. I don't know. I don't use it. Not currently invested in Ethereum. And so you've got this situation where we could definitely see a continued move in Bitcoin. Now, there are some important levels in Bitcoin. What's important to us? Trade and trend, as always. Trade levels, price volume volatility with a time series of 3 weeks or less. Trend levels, price volume and volatility with a time series of 3 months or more. Those are the important levels. That's what matters. And what are they? Well, for trade, Bitcoin's at just a little under 48,000. Now, it moves pretty fast. And just recently, when you've had a hard move up in the price of Bitcoin, both trade and trend are going to follow up underneath it reasonably quickly, too. Trend not as fast because it's a longer time series. The trend level for Bitcoin is just slightly under 45,000. So what does that mean? Well, the first level that you'd probably want to consider being a buyer of Bitcoin is the trade level, roughly. Right now it's 47,820. That's going to move up some more. So let's say it gets down to about the 48,000 level. That's probably an area where you might want to consider, if you're a crypto buyer, adding to your Bitcoin portfolio or considering a Bitcoin ETF, exchange traded fund. And there's a number of them on the market now that the SEC has approved an ETF or an exchange traded fund for Bitcoin. If the trade level breaks a little bit, it could go to trend. And chances are, if I had to guess, in this part of the economic cycle, the trend level would hold. So if you get down to roughly that 45,000 level, definitely an area to go bigger. Now, you can go back and listen to a few shows that I've done in previous market cycles, but most recently, as early as last month, one of the things I had commented on at that time was that the trend level for Bitcoin was about 40,700. And that if you get Bitcoin to get to that area and then hold or come underneath and then pop back up above shortly thereafter, probably not a bad time to be buying Bitcoin. And you had the opportunity to be buying Bitcoin at 37, 38, 39,000, 40,000 for several days. It just kind of traded in that range, and then it really started to move. So are we on the cusp of another parabolic move in the Bitcoin cycle because of where we are and what's happening in the economic cycle? Maybe. And it definitely starts to look like that the more you start staring at Bitcoin and the more you start looking at things like these altcoins like Avalanche, as I mentioned, Chainlink. Link is interesting. Chainlink, linked to the US dollar. It not linked to the US dollar, but when you look at the price of Link, it'd be Link compared to the US dollar. So Chainlink is interesting because it's a very useful network kind of a scenario. And again, I'd have to refer you to the software engineer people that can nerd out on this stuff. But bottom line is that Link is one of these altcoins that has a lot of potential. And trade level for Link is 1828. Let's call it 1850 because it's going to keep probably moving higher. Trend level is, let's call it 16. If you get the chance to buy Link in those areas, might not be a bad area to either start or add to your portfolio. Avalanche trade and trend levels are also interesting. Basically, the trend level is the best spot to be able to buy it at, and right now that's running roughly 36. And so if you see 36 on that, probably not a bad spot to buy. IMX trade levels at 275. Now, is it going to come down? I don't know. This is one of those things where these altcoins can just rip higher really, really, really fast. And okay, that's fine. You just have to be prepared to deal with the volatility that goes with these things. And none of these things, and this would include stocks, this would include bonds, this would include commodities and currencies. no asset should just be held to infinity. Our objective is to try and identify when market cycles peak and then ultimately start sliding down the economic sine curve, ultimately trough, and then start moving back up the other side of the economic sine curve. That's what a full cycle investment process looks like. You want to know the cycle of the economy and ultimately the market. And right now, the economy and the market are suggesting that we may have troughed and that we're starting to move back up on the other side. Now, there's certainly enough data to suggest that growth is reaccelerating. I talked about PMI, ISMs, talked about how inflation is starting to reaccelerate, all these different things that are going on. Are they starting to live within the confines of interest rates higher for longer? Are they starting to function on a scale where they're getting accustomed to dealing with higher interest rates? Are interest rates decoupling from the NASDAQ, typically a longer duration asset where rising interest rates are problematic for the NASDAQ? Yeah, it appears that could in fact be the case. Now, does that mean it's clear sailing and we're never going to get a bust? No, it doesn't mean that. What we have to look for are two main things. If we saw a major decline in Bitcoin, like if there was a big problem down move in Bitcoin, well, then that could point to a problem just simply because of speculation maybe getting wrung out of the market. But more importantly, and perhaps easier to look at and identify, would be what would be happening with the US dollar and what would be happening with volatility. So first and foremost, with the US dollar, it is, as I said earlier, bullish trade and trend. It is signaling higher highs and higher lows. Trend level for the US dollar is at 102.18. Now, if the US dollar were to break from where it's at now, the US dollar index symbol DXY is trading at 104.71. If it were to break down and break through that 102.18 trend level, that would be a problem because that would suggest that the dollar moves into a bearish trend, and a bearish trending dollar could in fact create an environment where we see, with the dollar having a positive correlation with the S&P 500, a headwind for U.S. equities starting to push them downward. But perhaps even maybe more important than that is what I alluded to and spoke about in a little bit more depth at the beginning of the show, and that's volatility. And not just volatility for the S&P 500, but volatility for the NASDAQ and volatility for the Russell 2000, the small caps. The Russell 2000 volatility indicator is bullish trade and trend, signaling higher highs and higher lows. That's not something that tends to be good for price. But the volatility indicator is in fact suggesting a rising, albeit slow, movement of volatility for the Russell 2000. In addition to that, the same thing is true for the NASDAQ. It's bullish trend. And as it's bullish trend, it's signaling higher highs. Now, does that mean that the NASDAQ can't go higher from here? No, it just means that it's got potentially some fireworks getting packed into it alongside what VIX is doing, that it's getting packed into that too. So we got to watch volatility really, really carefully. VIX is currently bearish trend, but if it moves back to bullish trend with both trade and trend levels below it, that could be an area where it supports a higher move. Okay, we're out of time once again, and I just want to thank you for spending some time with me today. If you have questions on anything we've spoken about, please give me an email, info@careformywealth.com, info@careformywealth.com. Check us out online, careformywealth.com. You can look at all of our old shows, you can read about us, you can look at our staff, all the things that you tend to do on a website, careformywealth.com. If you'd like to speak with us, that would be awesome. 866-596-9886, 866-596-9886. Thank you for joining us. This is the Care for My Wealth Show. God bless. Have an amazing day, and we'll see you next week.
But Jesus is the only name to remember.